Hello, everyone, and welcome back to Your Finance TV. Happy Friday. And as usual, as we get to the end of these months and start of a month, we get Jay Pelosky's monthly breakdown. How are you, Jay?
Hi, Scott. Very happy it's Friday. Been a long week.
Well, listen, I know our numbers might be down a little bit today just with everyone looking at Roaring Kitty and GameStop, but we're not here to talk about that because there's more to the market than just GameStop. Now, the title for your monthly is Who Will Win the Second Half of the 2020s? Talk to us about that.
Yeah, so this is the anti-GameStop video. We're focused on the next 5 years or so, not the next 5 minutes or 5 days. And we are very forward focused at TPW Advisory, and most recently we've introduced our global macro blue sky outlook, which extends from the 2023 to 2027 period. And now we want to build on that in this monthly with a focus on who will win the second half of the 2020s. And our thinking is really that we're in June of 24. Typically, this is when Wall Street starts to focus on the out year, that being 2025. 2025 is the halfway mark for the decade. So we want to maybe get ahead of that a little bit and kind of, do some blue sky thinking and contemplate where the different regions are in our tripolar world, right? Asia, Europe, and the Americas, the three poles of our tripolar world, and then within them, the leadership countries. Where are people and who's likely to win? And so we start by saying, okay, who won the first half? Because that's where we kind of need to begin. And we make the case that the U.S. Representing the Americas is the clear winner. And we show some great charts. Again, our full monthly 7,700 words, 25 charts and tables. Our executive summary here is only 1,100 words. So we make the case that the U.S. won the first half, superior growth performance post-COVID, driven by a Biden administration to go big. Biden, having been in the Obama administration, saw that going small after the great financial crisis really meant a decade of slow growth in the United States. Now we're talking about a Biden administration going big and resulting in better earnings growth, better stock performance, and a surge of foreign money into U.S. financial assets, which has pushed up the value of the dollar. And we walk through all of that. And so going forward, we say, okay, now given that, what are the key drivers, and then who's likely to do well? So key drivers in deciding who's going to win the next 5 years, we think governance is going to play a big role in that. Those governments that face reality and that are best able to integrate public and private investment at scale and with speed are likely to be the winners, because we're in an AI age. We're in an age of investment. That was the title of last month's monthly, The Age of Investment. So we're building on that work and making the case that the U.S., for example, faces a fork in the road in November. If we have a Democratic sweep, which very few people think is possible, we make the case that it is indeed possible. We think that sets the U.S. up to win the second half and win the 2020s as a whole, a continuation of the Biden policy approach. Should the former president, now convicted felon, Donald Trump, return to office, we actually think that that would be probably the best driver for Europe or Asia to win the 2020s. And we go into this in some detail. So Europe needs to build out its joint funding efforts to stimulate private investment and improve its productivity. Those are some of the things that we're looking for out of Europe. Parliamentary elections ongoing right now, going to be a key determinant of that. And then in Asia, which is increasingly centered around China, China is trying to rebalance its economy, protect its export machine by moving offshore, you have some great charts showing that the issue is not money coming into China. The issue is that China money is going out, setting up factories and plants throughout Southeast Asia, in Europe, and in the Americas to protect its industrial potential. And then, of course, there's the tech issue where the new thesis in China is delete A. And there's no prize for what A stands for. It stands for America. And so China is really now fully recognizing that the US wants to wrap China in a tech stranglehold. And China is taking the fight and is trying to delete American technology from its process. That's something we've talked about on this show. We think it means there's a big opportunity in China tech in what we call our two tech stack divide thesis. But those are just some of the nuggets that are in this monthly. We think it's a forward-looking effort. We cover the entire tripolar world with deep dives on Asia, Europe, and the Americas. And we think we've broken some new ground. So we encourage folks to take a look at it, listen to this video as we go through the rest of our process, and let us know what you think.
Just a reminder to viewers, you can go to Pelosky.com to sign up for those musings. But let's jump into a little bit more of the detail of the monthly, and let's start with climate. Biden's obviously putting more, I shouldn't say obviously, but it's put more tariffs on China's green energy exports. What are you thinking on that? What do you think implications are for it?
Yeah, the climate space continues to be very active. There's obviously the fusing of the AI digital age with the physical age through the powering of what NVIDIA's CEO, Jensen Huang, calls the AI factories, AKA data centers. And the power that they require is really having an impact on the commodity space and the climate space, because folks are trying to figure out, what does this mean, for example, for baseline power, right? Because these data centers, the power feed needs to be consistent 24/7, 365. And you can't do that with solar. You can't do that with wind. So there's a lot going on with this fusing. It's a huge theme that we're participating in, as we've discussed. The tariffs that you mentioned, I think more sound than fury, because the big attention getter was the 100% tariff on Chinese EVs. The reality is that China doesn't export really any EVs to the United States. There is the point that China went big in clean energy over the last decade, invested heavily, AKA subsidized, and now China is a dominant player in the tech space, in the climate space. They're dominant in solar, they're dominant in EVs, they're dominant in batteries. And so I think there's a real lesson here for the US and Europe. In the US, the Biden approach is in effect kind of a recognition that state-directed, what we call industrial policy, is really critical. First, critical in clean energy, and increasingly critical in the AI space as well. So we don't expect that dominance of China to really wane over the course of the next several years. But we do think that increasingly the fusing of the physical and the digital are going to really be a major player in how the climate space plays out. For now, China remains the top dog. They have excess capacity. The pricing, therefore, for things like solar, batteries, et cetera, continue to decline. So it's good for the world because the cost of renewables are coming down fast, but it's not really great for shareholders in that space. So you have to kind of pick your spots in the climate space. And we've done that by trying to focus more on the miners, copper miners, uranium miners, et cetera, than trying to focus on the renewables. solar or wind, which are, as I say, are much more problematic.
Let's move on to economics there. We've talked a lot about the macro surprises. You've been pretty well on the money with that. One of the things you highlighted was the US productivity and its widening versus Europe. Do you continue to see that trend happening?
Well, productivity is really a key, right? And this is one of the things that we touch on with the whole debate between what a Biden continuation would mean versus a Trump return to office, because productivity comes about by helping workers become more productive. Economic growth comes from more workers becoming more productive. So that's immigration has a big role to play. Immigration has had a major role to play in the U.S. growth outperformance of the last several years. Obviously, a returning Trump presidency with the promise of the most massive domestic deportation ever is not really going to be good for immigration and arguably not good for the economy. So productivity is important, and clearly for Europe, they need to improve their productivity. They need to improve their investment process. That's why we're looking for action on the Capital Markets Union to kind of deepen their capital markets, integrate across the European Union, more joint funding of things like defense, et cetera, likely to come out of Europe in the next couple of years because it needs to gross up to be competitive. And so, yes, we're not focused so much on the inflation issue. We think that's kind of in the rearview mirror. We're much more focused on growth, what drives growth, like productivity, what drives what's coming down the pike in terms of how Asia is going to trade more with itself. Have some good data in there showing the growth of intra-Asian trade and how Europe is going to be able to kind of move beyond some of the infighting that's taken place over the last couple of years. So there's a lot going on in economics front. We really are kind of making the case that our return to stability, which we think is visible through not just the VIX or the MOVE index, but the decline in inflation volatility, leads us to early cycle. And we demonstrate through looking at Asian export trends, whether we look at semiconductor demand, whether we look at an inventory restocking cycle in the US, we're making the case that we're in a global early cycle growth recovery, that growth is converging. So the US exceptionalism that allowed it to win the first half of the decade is starting to ebb as Europe picks up, as China and Asia pick up. And we think that is going to have implications down the road for financial assets, which we'll cover in the market section.
All right, well, let's move on to, as you know, my not favorite subject, politics. And now, listen, just as a reminder to viewers, it's not just all about US politics. There's been some other things that have been happening, which may imply some things that can happen down the road. Talk to us about those, Joe.
Yeah, well, I mean, clearly there's, as I say, or as we say in the monthly, there's no shortage of action in the political space, right? Mexico elected its first female president. Who would have thought that the land of machismo would have been the first to elect a female president before the land of DEI in the United States? So interesting there. Obviously, the India election's very interesting. A lot of talk in the lead into Modi being a dominant player there. That's been reeled back considerably, and a lot of activity in South Africa as well. And we're really interested in what it means for the U.S. and can we do any read-throughs. And one of the things is clearly you have to really take polling with a grain of salt. And I think one could argue that political polling in the U.S. is probably more developed than it is in places like India or South Africa, because the Mexican result was as expected. It was just bigger than expected, but certainly was not a surprise in terms of the new president. And so we really focus here more on the United States because we really do think, as I've already touched on a couple of times, that this election is pivotal for the U.S. And it's not simply because of, you know, you have a contrast between a convicted felon who is avoiding multiple other court cases with the support of his party, a party that is denigrating the U.S. Justice system, as opposed to encouraging the convicted felon to step away from his candidacy. And I think that really does show that the Trump effect in terms of erosion of social mores and kind of political mores has really been significant, because you can have a guy who's been convicted on 34 felony counts and no one is saying, hey, maybe you should step aside for somebody else. And we think that's going to, you know, spur voter demand for Democrats. We think the Trump family taking over the Republican National Committee is music to the ears of down ballot Democrats. And we show some interesting polling that suggests that in the head-to-head key Senate races, Democrats are ahead in pretty much every single one of them. And that's really where the attention is focusing below the presidency, right? The House is very tight. I think many folks would not be surprised if the Democrats regain control of the House. The Senate is more grounds for Republican pickup because the Democrats are defending many more seats. And therefore, we show this interesting polling suggesting Democrats are ahead. And so the real focus, and we continue to believe, is that President Biden will win in a landslide. And we're increasingly making the case that that landslide will include a sweep of all three branches of the presidency, the House, and the Senate by the Democratic Party, which would have major implications for policy. The other area where we focus is in Europe. The parliamentary elections are ongoing as we speak. They will determine whether the EC Commissioner Ursula von der Leyen will get a second term. It will set up the budget. In Europe's budget tends to go in 7-year cycles, so it's a huge deal. This upcoming budget is going to be very critical. And there's really a tight time window between when the COVID aid, which was the big joint funded effort by the European Union to stimulate the region, that funding runs out in 2026. And so there's a lot going on in Europe that has to, you know, that will be impacted by the elections there. And so we're really watching the far right party there. There's talk of a big surge in far right voting. The polls just before the last poll was allowed to occur showed that the far right parties, the Identity Alliance, as it's known, was expected to get about 10 or 11% of the vote. We'll see how that plays out. That's going to be important because the far right will kind of be a limiting factor in a lot of the spending efforts that the European Union, we, in our view, need, and Ursula von der Leyen will push for that spending. The far right will likely be a spanner in the works there if it gets a significant vote over the coming days here.
Let's move on to policy now. Obviously, we have the jobs number here today, which seems to have woken up all of the big banks' economists. And they're all now saying the rate cut's going to be happening in September or November. But we also need to remember they've been horribly wrong for this year. But Jay, as we just said before, it's not just about the US. We're looking at the global picture here. More rate cuts are coming.
Well, yes, we're believers that we're in a rate cutting cycle, and it's something we've been talking about for 6-9 months. It's been led by the emerging markets. The G7 central banks are now following suit. We had Bank of Canada be the first one to cut earlier this week. The ECB cut the other day. The Fed is going to come last. That's not really a surprise. But again, the point to us is that monetary policy was the action for the last go round, right? What we think is a critical component going forward is fiscal policy. Again, the age of investment, the AI age, the need to build out clean energy, build power to fund the AI or to provide for the AI compute needs. All that's going to take a ton of money. And so fiscal is in the leadership position policy-wise, not just in the US, as you point out, but certainly globally. And so, the countries that are able to best balance that fiscal issue together with the private capital raising are going to, and then funnel that money appropriately, are going to be the winners of the second half of the 2020s. And that's really our focus on the policy front. It is critical in the US. And as we said, President Trump gets back in office, Trump tax cuts, huge fiscal deficit, likely inflation spike. There's more and more folks talking about that. We agree with that thesis, which is why we say a continuation of President Biden from a policy perspective certainly would be much more supportive of the U.S. Continuing to do well in the second half of the decade. In Europe, really what's interesting is Mario Draghi, the famous former head of the ECB, who said he'll do whatever it takes and really stem the tide now about a decade ago in the European bank crisis. He's writing a competitiveness report. What does Europe need to do to maintain and restore its competitive positioning? Because Europe is recognizing the tripolar world, right? It's getting pressed by the US, it's getting pressed by China. And so Europe is going to look to Mr. Draghi's report to help understand what needs to be done. Japan, moving to Asia real quick, Japan moving out of deflation fighting, raising rates, focusing on how to leverage inflation and restore nominal growth and real growth, while China has got a number of policy challenges, right? It needs to stabilize, which we think it's doing. We talk about a wide policy U-turn. So China is making a big policy turn. They're just doing it slowly so that no one gets blamed for the mistakes that's been made over the last couple of years. And so they're trying to put a floor under the property section, stimulate domestic consumption, drive tech self-reliance, and maintain their export engine by developing plants and platforms offshore. So a heck of a lot of stuff going on in China as well. As you point out, Scott, it's definitely not just the US. In the tripolar world, in a TPW advisory, we really focus on the entire globe.
This all wraps up into markets and gives you an overview of it, like where the opportunities are. We talk about them all the time. But just to reiterate this to the viewers, let's talk about markets.
Yeah, well, I mean, it's funny how that works, right? You would think somebody actually maybe thought about that to put it all together and end with the markets. Guilty. So, no, as you point out, we talk about it every week. No surprise, we remain constructive. We remain overweight equities, overweight commodities, very focused on that physical and digital fusing through the power of the AI factories. Very much focused on our pick and shovel investments in those two realms. In the digital realm, we want to be in the semi space. In the physical realm, we want to be in the miners. So these are big core positions within the equity space. We continue to be overweight emerging markets equities. We continue to like our two tech stack divide thesis, which says we want to own China tech because that's going to control that huge Chinese tech market as the U.S. companies are forced out, just as the U.S. are forcing Chinese tech out of the U.S. tech stack. China's doing the same to the U.S. Opportunity in China tech. In the commodity space, where we believe we're early in a secular bull market, we expect that the global convergence of growth we spoke of earlier is going to be dollar negative. Weak dollar supports commodities. Weak dollar supports emerging market assets. And within the fixed income space, we continue to be deeply underweight. That's what funds the equity overweight and the commodity overweight, a deep underweight of fixed income, and particularly a deep underweight of sovereign debt. Our exposure in fixed income is very heavily concentrated on credit, both high yield in the US as well as high yield in Asia. And we have some great charts there. We think Asian high yield is very compelling at this moment. As Asia recovers, you have a big yield pickup that is been built in because of the China property concerns over the last few years. As that becomes less of an issue, that Asian high yield credit, we think, should do very, very well. So those are our positions in the fixed income space. As we mentioned, expect dollar weakness. We did note, for example, when you touched on all that political action, it was really interesting Monday and Tuesday to watch the broad EM ETF, so symbol EEM. It was relatively flat on Monday and Tuesday when Mexico was gyrating down. I think EWW fell 10% on Monday, which is just like an absurdity. And then India fell, I don't know, 5-6%. Broad EM was effectively flat. And as you know, we like to listen to stocks, not VOTs. And that flat performance by the broad EM ETF told us that this was not a wholesale emerging market panic. This was very focused on specific countries. And that gives us some comfort, as does the Europe making a new all-time high this week. We're big believers that the European economy, European earnings growth, not just this year, but next year is going to be double digit. In fact, we have a great chart showing that earnings growth in the US, Europe, and China is going to be double digit in 2024 and 2025. And the very early estimates for 2026, available only for the US, is also double digit. So if you're having double digit earnings growth and double digit stock buybacks, as are expected in the US and Japan, stocks are going to be okay with that kind of underpinning. And so those are some of the facts that support our thesis and our opinion that we want to be constructive to risk assets. So short term through the end of the year, constructive. Medium term through our 2027 blue sky period, also constructive. And it's interesting, we highlight Dr. Ed Yardeni, who put out a piece recently talking about what he thinks is going to happen in the second half of the 2020s. And he's talking about an S&P number that I believe is 8,000 for the S&P by 2030. And he lays out how you can get there with earnings growth and very little multiple appreciation. And that's the kind of thing that we think investors should be focused on rather than GameStop.
And since we've been on here, like the stock, GameStop's actually plummeted. But maybe people are listening to us, Jay.
There you go.
All right, Jay, listen, thank you so much for that breakdown again, as always. We'll be back again next week, everyone. Jay, you have a great weekend.
Thanks, Scott. Same to you. Enjoy the cricket.
Thank you. And for everyone else out there, good luck investing.